When it comes to investing, there are so many choices to choose from. But as an investor, you need to be able to separate a company from a stock price. You could love a company, but may not necessarily love the valuation of a stock price. And in today's video, we're going to look at 3 very popular companies, and we're going to put them into one of 3 categories: buy, sell, or hold. So make sure you stay tuned throughout the entirety of today's video. And each week we put out multiple videos. So if you could do me a huge favor, show your appreciation by clicking that like button down below, that would be greatly appreciated. And before we begin, make sure you subscribe to the channel as well. And let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, take a look at 3 popular companies, and let's begin with a positive. Let's begin with the stock that I rate a buy. However, this particular company has taken a beating in the markets, and with that, the valuation looks great. However, there's a caveat here. This is not a company that I believe is going to be able to flip the switch and be a quick turnaround. But at today's valuation, you're getting a great company at a great entry point. A great valuation. And as long-term investors, as value investors, that's what we're constantly looking for, to enter into positions at great valuations. So without further ado, the first company that we're taking a look at today is Starbucks Corporation. Stock ticker SBUX. Starbucks is the premier coffee house here in the world, not just here in the US, around the world. Their 2 largest markets are the US and China, but they have a global presence. There is no doubt that this company has brand recognition and a moat in its field, because we have seen a number of various coffee chains come and go over the years. Now, don't get this mixed up believing that they don't have any competition, because competition is fierce. They have strong competition from the likes of Dutch Brothers, as well as Peet's Coffee, as well as Dunkin', among many other names. But when it comes to Starbucks, they do have a unique customer base, many affluent customers, many loyal customers. After all, the company has 32.8 million active users. This means customers that are regularly using their loyalty membership. The total number of members is actually much higher. Active members, in fact, climbed 6% year over year in the latest quarter. And we will be taking a look at that latest quarter, which was a doozy, and not in a good way. But let's look a little bit closer at Starbucks, the company, first. As I mentioned, Starbucks trades under the ticker SBUX. They have a market cap of $88 billion. This was a company that had a value in excess of $100 billion not too long ago. And over the past 12 months, shares are down 21%. And year to date, a lot of the same, down 19%. That is a brutal performance when looking at both periods. And this also marked the first full year under the new leadership of CEO Laxman Narasimhan. So far, not off to a hot start in terms of stock performance. But now let's take a closer look at company performance from their latest quarterly results. As you can see on your screen here, the company reported revenues of $6.4 billion, which was exactly flat year over year. EPS came in at 68 cents per share, which was down 8% year over year. Operating income came in at $1.1 billion, also down 6% compared to the same quarter a year ago. Operating margin, again, also down to 18%, as that fell from 19.1% a year ago. However, on a positive note, free cash flow improved to $1.6 billion, which was a 20% increase year over year, a lot of that having to do with inventory. And year-to-date free cash flow margin increased to 25.6% from 21.3%. So those were the actual results, but how did the company fare as compared to what analysts were expecting? Well, as you can see here, analysts were expecting EPS of 80 cents per share. In the latest quarter, the company reported just 68 cents per share. The revenue expectations were $9.16 billion. Actual revenues came in at $8.56 billion, missing by roughly $600 million. Huge misses on both the top and bottom lines. So what are some of the primary drivers when it comes to Starbucks? Well, it was a lot of customers that were pushing back on higher prices. Starbucks has seen, just like everyone that has been dealing with higher inflation, they've seen higher costs. And what do companies tend to do? They try to push as much of that cost onto the consumer as possible. However, they may have pushed too much because we saw declines when it comes to traffic. Also here in the US, their two largest markets are the US and China, both areas that had rough quarters. The US saw same-store sales decline by 3%. China down by 11%. And we know all of the struggles that have been going on over in the Chinese economy of late. So higher costs as well as some new drink offerings haven't really resonated great with consumers of late. So again, I have no doubt that this company is going to turn things around. I don't think it's going to be a quick fix, but strong brand recognition, loyal customers is a great combination. So this is going to be a great value play, and we're going to look at value here in a second, but let's first take a look at the dividend. As you can see here, the company pays a dividend of $2.28 per share, which equates to nearly 3% in terms of that dividend yield. The company has also been well known for its strong dividend growth, just recently dipping under a 10% 5-year dividend growth rate. They have also increased their dividend for 13 consecutive years and counting. Now let's take a glance at what analysts are looking for in terms of guidance over the next 3 years. I like to use 3 years as a guide because outside of that, the number of analysts making estimates falls off considerably. As you can see here at the top, that's going to be your EPS estimates. And at the bottom of the screen is going to be your revenue estimates over the next 3 years. EPS is expected to grow at an annual average rate of 14%, with revenue growing 8.5% per year over the next 3 years on average. Now let's take a look at valuation, where Starbucks shares have a forward PE multiple of 18.8 times, well below the company's 5-year historical average of 31.1 times. Now, again, they're not growing, as we just saw, as fast as they once did. However, I don't think they should be below a 20 times multiple right now, as they tend to be above 30 times, but let's just say they get back to 25 times. That's still huge upside for a company like Starbucks. In terms of EV to EBITDA, they trade at 14.9 times. 5-year average, 20.8. Again, well below the 5-year average. And then in terms of price to free cash flow, shares trade at 11.9 times, well below the company's 5-year historical average of 19.5 times. So across the board, after those results, the stock dropped considerably and shares look rather intriguing. But at this moment right here, investors are saying, I want to see the turnaround before I jump into it. And that's a great approach at times. There is no problem with waiting to see just to make sure that you do not catch a falling knife. Now let's take a look at what analysts believe in terms of price target. Do they believe there is a turnaround story when it comes to shares of Starbucks? As you can see here, analysts rate the stock out of 27 analysts. They have a 12-month average price target of nearly $90. This implies close to 15% upside from current levels. So again, not a great first year for the new CEO here. Even the great Howard Schultz, who once ran this company for eons, it seemed like, 2 different stints from that standpoint, he actually placed the CEO and did an open letter openly bashing him from that standpoint, which I didn't think was all that necessary here. But we want to give the management team a little bit more time, not just 12 months to turn things around here, because we have seen cracks in the consumer here. So let's wait another year from this standpoint. And this is a great spot to start nibbling. So I believe a great spot for me personally to start jumping into more Starbucks shares is going to be around that low $70 range. So with that being said, I rate shares of Starbucks as a buy. Now let's move on to our next stock, which I have crowned the golden child of the stock market, or of the S&P 500, or of probably your portfolio if in fact you own this stock, and that is none other than NVIDIA, stock ticker NVDA. If you're brand new to investing and you just got started in the last couple of years and you own shares of NVIDIA, this performance is not normal. So don't think that this is going to be a performance moving forward, but it has just been miraculous to say the least. I get questions on NVIDIA every single week talking about, with this huge performance that it's seen, some folks are late to the game. They always ask me, am I too late? Well, considering I get those questions on a weekly basis, I figured let's just look at it together. As I mentioned, NVIDIA trades under the stock ticker NVDA. They have a market cap of $3 trillion. Over the past 12 months, there's no typos here, the stock has increased 200%. And year to date, up 150%. That is just wild to think of. This is the company that has created the best performing, the strongest, the most powerful AI chips in the world. Whether we're talking about data centers, whether you're talking about gaming, computers, autos, they have demand that they are not even close to keeping up with. Now let's transition over to the numbers to see, okay, strong stock performance, but do the numbers back it up? As you can see on your screen here, Q1 revenues came in at $26 billion. That is growth of 262% year over year. Q1 adjusted EPS came in at $6.12 per share, up 461%. Again, no typos here. Q1 operating income came in at $18.1 billion. That's up nearly 500%. How about operating margin? Came in at 69.3%. This time last year, they were at 42.4%. So not only is this company making more money, they obviously have pricing power, but they're becoming much more efficient as well. Free cash flow for the quarter came in at $15 billion. That was up 462%. And their free cash flow margins continue to improve. This means for every dollar of revenue that they're generating, 57.5% is being turned into free cash flow. That is great improvement from this time last year when they were at 37%. Now, NVIDIA also happens to be a dividend stock, technically. Not anyone out there. There is not one person out there that invests in NVIDIA for the dividend, but let's take a look at it. As you can see here, NVIDIA pays 4 whole cents. You get 4 pennies for every share that you own of NVIDIA, which equates to 0.03%. And they don't really grow it that much. Not really sure why they even pay a dividend. So let's get back to talking about the results here. And we know that the company has a massive backlog. They've had very strong performance. So a lot of that's going to continue to trickle in to their financials over the next 12, 24 months from that standpoint. Let's see what analysts believe the company is going to generate. What is their guidance over the next 3 years? As you can see here in terms of EPS, which is at the top of your screen, you could see the company has a 3-year average EPS growth rate above 50%. And for revenues, right below 50% at 48% per year. So how does this equate to valuation? Well, let's take a look right now to see if the stock is still worthy of a buy or not after this historic run. Looking here, the company trades at a forward PE multiple of 45.6 times. And based on their growth rates, they have a PEG ratio below 1 at 0.88, showing solid value from that viewpoint alone. In terms of EV to EBITDA, they trade at 60.8 times. However, this is above their 5-year average of 57.7 times. Price to free cash flows at nearly 70 times, compared to a 5-year average of 51.4 times. So again, from a PEG value metric, this stock still looks rather cheap. The PE that you're paying compared to the growth that's expected to come moving forward, it still appears like you're getting great valuation. But when you look at all the other metrics, it's still a very high PE. It's definitely not a low PE by any means, but a very high EV to EBITDA, a very high price to free cash flow from that standpoint. I never like to invest based on one multiple alone. I like to take the sum of the parts approach. So before I get to my rating, let's take a look at what analysts think for the next 12 months, as they rate the stock still a buy, but there's really limited upside there. So they have an average 12-month price target of $135, implying less than 10% upside from current levels. So really, analysts think the stock has ran its course, at least for a little bit. We know all the demand's out there. We need to see it come to fruition. So for that reason, and I own NVIDIA. I haven't sold NVIDIA, but I also haven't bought any NVIDIA in a little bit here. That's why I rate the stock a hold right now. This has been a stellar performance, but you gotta let the financials catch up. You gotta let the performance of those financials catch up. The free cash flow, the revenues, which have been amazing from that standpoint. But look how much we have pulled forward. Look at what the market cap has done over the past 24 months. Is that much replicated? Is the company going to be able to replicate that much moving forward? That's what everyone has to ask. And that's what you have to ask before you actually purchase this stock. So when it comes to NVIDIA, I rate them a hold at this very moment. Now we're going to get into the final stock we're going to discuss today. And it probably doesn't take rocket science to understand what I'm going to rate this particular stock. And this is another great example. This is a perfect example of what I talked about at the start of today's video, when I said, as an investor, you need to be able to separate a company from its stock price. And this is one where I love the company, but I hate the valuation right now. It's just not a good valuation whatever angle you look at it when it comes to this stock. And the stock, and it's going to be a bit controversial here, I bet, but the stock is going to be Costco Wholesale. Stock ticker COST. I really wish I could like the stock here. I just can't, and we'll take a deeper dive here right now. So as you can see, Costco trades under the ticker COST. They have a market cap of $376 billion, and this is another company that has been performing excellently from a stock price performance. Over the past 12 months, the stock is up 63%, and just year to date, halfway through the year, they are up nearly 30%. So with that, now let's take a look at the actual performance. Let's dive a little bit deeper into the financials to see, okay, that's great stock performance, but what are we doing in terms of company performance? As you can see here, the company generated $58.5 billion in their most recent quarter. That was a 9.1% year-over-year increase. EPS came in at $3.78 per share, which was nearly 30% year-over-year increase. Operating income came in at $2.2 billion. That's 31% increase from prior year. But look at these margins. Costco, a very low margin business. Their current Q3 operating margins are at 3.8%, very low, but it is up from the same time prior year when they were at 3.1%. In terms of free cash flow, the company generated $5.2 billion year to date, which is up nearly 15%, and they have a free cash flow margin year to date at 8.9%, slight improvement from last year when they were at 8.5%. So as you can see here again, this company is a very, very low margin business. The majority of their margin is coming from those membership fees. This is how the company is able to offer such great prices to its consumers. Offer a membership and then keep their prices low as much as they can. So what are some catalysts when it comes to Costco? Well, it's going to be an increase in that membership fee, which a lot have been looking for. But with the state of the consumer, I think the company has done a good thing and have waited. They've put a pause on taking the initiative to increase those membership fees for the time being. Another catalyst hire is going to be international expansion. So Costco also, like Nvidia, pays a dividend, but a small dividend at that. As you can see here, the company pays a dividend of $4.64 per share, so much higher in terms of dollar amount, but the dividend yield still quite low at just 0.55%. However, Costco has been known to have strong dividend growth, and they have been known to pay special dividends. The company has a 5-year dividend growth rate of 12%, and they've been increasing their dividend for nearly 20 consecutive years and counting. Now let's take a look at guidance for the next 3 years. As you can see, EPS at the top, and they have a 3-year average EPS growth rate of 8% per year. And for revenue, they're right around 7% per year. Now let's take a look at valuation and see if this stock is worthy of a buy. As you can see on your screen, they trade at a forward PE multiple of 48 times. The company already historically trades at a very high multiple. People love this stock, but this is well in advance of that already high multiple, which has a 5-year average of 38.7 times. The company trades at an EV to EBITDA of 33.1, well above their 5-year average of 23.1. And they have a price to free cash flow of 35.8, well above their 5-year average of 24.7. So as you can see, very, very high multiples, whichever angle you're looking at, whether it's PE multiples, whether it's EV to EBITDA, or whether it's price to free cash flow. When you look at just the PE multiple, this is the stock that is trading at a higher multiple than the likes of Nvidia. If I only gave you 2 choices to choose from for the next 12, 24, 5 years, whatever it may be, and I said you could only choose Nvidia or Costco, I bet the majority of you watching this are going to select Nvidia. A higher multiple, a much more expensive stock than the likes of Nvidia. Nvidia is expected to grow exponentially over the next few years in terms of EPS growth, in terms of revenue growth. We're talking about with Costco, not only is it a higher multiple, this is a company that's growing less than double digits. They're in the single-digit growth from both revenue and EPS standpoint. Analysts also don't see much upside, as between 26 analysts, they have an average 12-month price target of $860 per share, implying pretty much no upside from current levels. This is a stock that, if I in fact owned it, I would probably likely be taking profits at these levels. Again, a great company, a company that I shop at and can get lost in for over an hour, and it's pretty much the over-under on the bill is going to be around $200 plus, usually on the plus side of things. But again, love the company, but do not like the stock valuation whatsoever. So down in the comment section, we looked at 3 great companies, 3 popular companies here: Starbucks, Nvidia, and Costco. How would you rate them? Let me know down in the comment section. If you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.